See, now that we have discussed on capital budgeting, wherein each of the future cash flows we are discounting at one specific rate of return. Let's say when we are using the NPV, the discounting rate which we are doing, we also called it as cost of capital, which is nothing but the capital you are raising, any company for that matter, whether it is my own funds also, right? You should not see that I have taken a loan only. Even my own funds also, the opportunity cost is there. If I am putting in a project, I am actually losing an opportunity to invest this money elsewhere. So, whenever we talk about the cost of capital, the total capital that comes into the company, what is the cost associated with it? So, the company can raise capital in multiple forms, some portion in the form of debt, loans, some portion in the form of equity, which is the promoter's own capital or from the shareholders, whatever it is. Some portion could be in the form of preference shares, which is having a mix of these two characteristics. So, in different forms, the capital can be raised. So, for each of the form, there is a cost. The cost associated with the debt capital is called as interest. The cost associated with equity capital, we call it as dividend. Cost associated with preference share capital, we call it as preference dividend. So for each of them, so basically in this chapter we deal with these three sources of financing and the costs associated with each of these, and finally the weighted average cost of all these things is what we call as cost of capital, depending on how much portion I have raised in the form of debt, what percentage of my total capital is in the form of debt, what percentage of my total capital is in the form of equity, and what proportion in the form of preference shares. I take their proportions and their corresponding costs and compute what is called as a weighted average cost of capital. So basically, weightage in debt, weightage in preference shares, weightage in equity. These are the three forms of investments I have. So how much proportion? Probably 40, 10, 50. That is the way the proportions are. So each of them costs. Okay, what is my interest rate? Is what is my cost of debt? We'll talk about how do we determine and all. My interest costs are contributing to the cost of debt. What is the preference dividend I have to pay? Contribute what proportion, what percentage of preference dividend I have to pay comes in the form of cost of preference dividend. Similarly, cost of equity share, what is the dividend I am paying, is what is coming out as the cost of common equity. The multiplications and additions of all of them is what is coming out with my cost of capital, or in detail it is even called as weighted average cost of capital, because I am doing a weightage, I am doing a weighted mean, and weights are being given based on the proportions of investment in each of the proportions of proportions in which the capital is raised in the form of debt, preferred stock, and equity. Now, in this, the only thing that is slightly confusing is this subtraction of 1 minus t. Otherwise, you look at it, WD, weightage of debt into cost of debt, weightage of preference shares into cost of preference shares, weightage of common equity shares into cost of common equity shares. There is only one aspect that is coming up as a slightly different part called as 1 minus t as a part of cost of debt. We'll discuss on that. And the other name for weighted average cost of capital is also called as marginal cost of capital. Why is that word marginal? In finance and economics, the word marginal is always associated with, if at all I want the next extra thing, that is what we consider as marginal. So what am I saying here in marginal cost of capital? If at all I want to raise $1 right now, if at all I want to raise $1, it would cost me overall that much percentage. If my cost of capital is, let's say, 15%, if I have to raise $1 right now, in the same proportion of what I have, debt, preferred shares and equity, if I have to raise $1 right now in that same proportion, it would cost me 15 paisa or 15 cents for each dollar. So how does that, how do I link it with my capital budgeting project? The IRR of the project which I take up should be more than 15%. Because my investors, my different sets of investors will take 15% of whatever I'm investing. So if the company really needs to have some additional value, it should generate more than 15%. So whatever that extra it generates, it will add up to the value of the company. That's the reason. Because after these guys take up their 15%, whatever is left, that belongs to the company. Right? Company treat it as a virtual entity. Company is not owner. In any parlance, company and owner are two different words. Company is, look at it as a separate legal virtual entity. Some other person. Company is some other person. So Mukesh Ambani has nothing to do with Reliance. Mukesh Ambani is one of the shareholders of Reliance. Right? Reliance is a company specific, independent entity, independent from Mukesh Ambani. Because Mukesh Ambani holds more number of shares of Reliance, he is literally managing the operations of the company. Right? He is the chairman of the company. So from a legal parlance, company is a separate existence altogether. So even Mukesh Ambani also will be taking his own share. So whatever comes additional, whatever, if a project is generating something additional above the required rate of return or cost of capital, that is what is adding value to the company, and that is what will result in share value, share price typically going up. So the cost of capital is computed as weighted average cost of capital, and the weights are given based on the market values, not your actual investment, based on the market value of debt, market value of equity, and market value of the preferred share. Market value of the equity you can easily get based on the share price and number of shares that are there. That is the market value of equity, otherwise we call it as market capitalization. Market value of the debt, if that bonds and loans are traded in the market, whatever is the market value associated with that, I'll take that as the total investment value. Like that, for each of them, first choice always is the market value. If at all those bonds are not traded and there is no market value associated with them, then probably I may prefer the book value itself. Otherwise, every year I will update my weighted average cost of capital by basing it on the market value of the debt, equity, and the preferred stock. And so any of your capital budgeting decisions, the NPV formula or the comparison in the IRR, it will be done against the cost of capital itself. The computation of the NPV as well as the evaluation of the IRR, it happens as per the cost of capital itself. And we make the relevant adjust. See, sometimes cost of capital is what? The cost of the all set of money that a business is getting. Whereas from a project standpoint, not all projects will have the same type of risk. Some projects can be more risky, some projects may be less risky. So obviously more risky project should give me more returns, less risky project should give me less return. Again, a simple funda in finance across high risk, high return. So it's not worthy to discount it with the same cost of capital for all kinds of projects. If the project is more or less similar to the other average projects of the company, I'll use the same cost of capital to discount it. But if the project is a very risky project, probably I may add, okay, to the cost of capital, let me add another 3% because I require higher return. So to the normal cost of capital, let me add up a slightly higher amount of return, higher 2%, 3%, and then use it for the discounting purpose. If it is a very low risky kind of a project, let me take out that 3%. So some small adjustments over that cost of capital can also be done to evaluate your capital budgeting kind of projects. Then, so just a quick numerical. So a company has, okay, we'll come back to it, but a company has 30% in debt, 10% in preference shares, remaining in equity. So which is 60% is in equity. Then cost of debt, cost of preference shares, and the cost of equity 10, 12, 15. They are all pre-tax and tax rate is 30%. Okay, as per the formula, we have done weightage of debt, cost of debt. For that we have done 1 minus T. T is nothing but tax rate. We'll see why we are doing 1 minus T only for debt and not for cost of preferred stock and cost of equity. See, the logic is the interest, whatever a company is paying, it will get the tax benefit to that extent. Any interest the company is paying, it will get a tax benefit to that extent. So, though it has to pay 10% as tax, 10% as interest. If the tax rate is 30%, it will save 10%, 30% of that 10%, which is 3%, it will save in the form of tax. So literally, the loss which the company, the cost which the company is incurring towards that interest payment is only 7%. Whereas it does not get any kind of a tax benefit with respect to the payments towards preference stock or even a common equity. Whereas with respect to the interest payment, even if you remember, if you see, even in our house loan kind of loans which we take, the interest that we pay on the house loan, we get a tax advantage associated with that. So that's the same funda applicable even for the companies also. Any interest payment that they are doing, they get a tax benefit. So whatever is the interest payment, let's say I'm paying an interest of $100,000, 30% of it is a tax benefit. So literally I'm paying only $70,000. So that's the reason when we compute the cost of debt, we remove the tax portion of it and we say only post-tax cost of debt. Pre-tax, if he is giving in the question, remove the tax part and take, that's the reason we multiply it with 1 minus P, because in almost all scenarios across all countries, we see this kind of application existing. Interest is tax deductible. Any interest payment which any company is doing, it will save, it will have a benefit in terms of tax to that extent. So if 10% is the pre-tax cost of debt here and the tax rate is 30%, so 30% of that 10% is the tax saving which the company is getting, which is 3% of the overall is actually the tax saving which the company is getting. So it's only incurring a real cost of only 7%. That's the reason we take WD into not 10%, will take it only as 7%. That's one aspect that we need to be comfortable with. So this is what it is. So when we talk about for preferred stock or common equity, they are not tax deductible. Whereas in case of debt, there is a tax deductibility that is applied. So any debt interest that you are paying, it comes under the tax deductibility scenario. And now coming on to the next aspect, how do I determine the weights? In the beginning we have mentioned already that the weights are defined based on the market values. The weightages I'll take based on the market value of the debt, market value of the preferred stock, market value of the equity. But if the market values are not properly available, there are three more routes that I will typically take. The first being the target capital structure, or probably market values also, not the current but the target. For next year, what is my target capital structure? See, today it may be 30, 20, 50. 30 in debt, 20 in preferred stock and 50 in equity. But probably let's say the company is announcing that next year we want to go with 40, 10, 50. Then for computing my cost of capital, I will go with 40, 10, 50. But if there is no such information about the future, then I will take the current capital structure itself. If there is some information the company mentioned somewhere as a part of its financial statements or annual reports, that next year we are planning to raise more loan and pay off the preference shares, some such kind of statements if they are existing somewhere, then I will take the target capital structure, the weights WD, WKP and W preference shares and W common equity shares, I will consider based on the target capital structure. But if the target is not available, then I'll go with the current capital structure. And even if the current capital structure is not available, then I'll look at the industry average. What is the current capital structure not available if the market, if the stock is not, if the stock is not traded, or probably if the bonds are not traded, market values are very difficult to get if they are not traded, or if they are illiquid, market values are difficult to get. In that case, the suggestion is probably take the industry average. So one of these I have to take, and based on that I am trying to compute my weighted average cost of capital. Then see, now my intention is to design a mechanism which will identify what is my optimal capital budget. It's nothing but combining the cost of capital chapter with the capital budgeting chapter, right? What I am trying to do in this exercise is, at each level of capital investment, I am looking at cost of capital. So what does that mean for me? Let's say, see, from a company standpoint also, it will so happen that if I am raising a small capital, let's say 100 million, my cost will be much lesser. But if I am raising 150 or 200 million, my cost will be slightly more. If I am raising 500 million, the cost will be even more. Why? Generally, in most of the businesses, we have the economies of scale coming up. The higher the volume, the cost will actually come down. But this is one area where if the volume is increasing, the cost will actually go up. Because the other party, the lender or investor, he feels more risky. If it is a huge amount that has to be given as a loan, the investor or a lender will feel more risky in the process. And because of that, what will happen? The cost of capital actually goes up with the amount which you are raising. The higher the amount, this is one place where economies of scale do not operate properly. The higher the capital you are raising, the higher is the cost associated with it. So there are slabs, okay, from 0 to 100 million. This is the cost of capital. 100 to 250 million, this will be your cost of capital. 250 to 500 million, this will be your cost of capital. So whatever that comes out, it comes in some stages, right? It